Good afternoon. Welcome to the 2016 NEPC Defined Benefit Trends webinar. This webinar is being recorded. All participants will be in a listen-only mode. A copy of today's presentation, as well as the slides and recording, will be available on our website at www.nepc.com. If you would like to answer or ask a question, please do so at any time using the Q&A function on the lower right-hand side of your screen. My name is Brad Smith. I'm a partner in NEPC's Defined Benefit Corporate Practice out of Atlanta. Joining me on today's call is Dave Moore. Dave is a partner in our Charlotte office and works on our healthcare team. And also joining me today is Kevin Novak. Kevin is a consultant working out of our office in California. We have two primary topics we're going to cover today. The first will be a market review, providing an update on activity since last year's trend survey. Then we're going to get into our findings on the 2016 Defined Benefit Trends survey. We do have about 30 minutes worth of prepared comments, but we will be able to have plenty of time for questions at the end. In this year's survey, we found three central findings. The first of which is that risk management works. What's really interesting is LDI is fundamentally a risk management decision. It is not an investment decision. And plan sponsors that had high usage of LDI in 2016 really saw much lower funded status volatility than plan sponsors that did not use LDI. We also saw that the recent PBGC premium increase really stimulated a lot of sponsor activity in 2016 as plan sponsors looked for strategies to de-risk the overall size of their pension liability. And finally, which was really fascinating to see, was that despite a lot of headline stories around public sector funds getting out of hedge funds and alternatives, with respect to corporate defined benefit pension plans, it appears as though these types of investments continue to remain a popular choice, and we really expect that to continue going forward. For those of you that aren't aware of NEPC, NEPC is one of the largest independently owned investment consulting firms in the industry. We have 251 employees, 92 consultants through 6 regional offices. We have 50 dedicated research professionals supporting over 350 retainer clients, representing about $920 billion in assets under advisement. As investment solutions have become more complex and the needs of our clients have become very specialized, NEPC has responded by focusing our consultants into practice teams. Kevin and I are on the corporate defined benefit team. Dave is on the corporate healthcare team. We also have a dedicated defined contribution team. As you can see on this slide today, this is a perfect example of why we've specialized into corporate teams. If you think about the average healthcare client out there, they have multiple different asset pools with very different and unique needs. And one of the strengths of NEPC is we're able to focus people's talents and 100% of their time on finding solutions for each of these asset pools. If we step back and look at what happened during 2015 into 2016, you can see that the blue line on this graph on page 9, the top line is the corporate AA curve. You can see that the crediting rate has been going down through about August of this year. You can see spreads were about 129 basis points at the end of the year. We've seen a spike up since the election, but we've also seen credit spreads come in a little bit. So a lot of plan sponsors, if you're looking for your funded status to improve dramatically with this most recent spike up in rates, might be a little bit disappointed because spreads have come in a little bit more than we would have expected. What's interesting is that BNY Mellon Investment Solutions Group publishes a average funded status of the typical corporate plan out there on a monthly basis. And what you can see is, despite that volatility in rates that we saw on the prior page, the funded status for the average plan has pretty much averaged around 80% through 2016. We did do this survey through August of 2016, and we did ask participants whether they were more bullish or bearish on the market for the balance of the year. Similar to last year's survey, it was essentially a coin toss. Slightly more respondents were bullish than bearish, and you can see that clearly the bulls were correct if you can see what happened post-August. What's really interesting is if you looked at the consensus estimates of management, what they expected to happen with fixed income for the balance of the year, just about everybody expected the Democrats to hold on to the White House, which really meant no change in fiscal or monetary policy. At the margin, I believe a lot of investors expected higher taxes, and the view on rates was that Clinton was going to continue the Obama mantra of keeping rates lower for longer. What was interesting is once you kind of divorce the personalities from the election and actually started to look at some of the fiscal policies that were being proposed by the Trump administration, a lot of investors were, I guess, pleasantly surprised or surprised to see he was really in favor of a huge infrastructure spend, very fiscally stimulus process, a lot of fiscal spending. The initial gut reaction right after the election was that the Fed was probably going to pause rate increases in December initially. As we sit here today, the futures curve is pricing in essentially a 100% increase in December probability, if you will, and then two more, about 80% probability of two more increases during 2017. If we look at the equity markets, investors were also expecting a continuation of Obama's policies and continued gridlock. And for equity investors, a lot of them viewed gridlock was good because it meant there was greater certainty around a lot of regulations. But those regulations were a negative for healthcare and financials. With the rise of the global populism, if you will, combine that with Trump's fiscal policies, which were considered pro-growth, lower taxes, less regulation, really the trade policy and impact globally has really impacted the equity markets, and we've seen a tremendous spike up. But it's really been targeted. In fact, if you look at companies that have less exposure to non-dollar revenues, those companies have done incredibly well. You can see that here on this table when you look at the small cap performance. Small caps are up about 12.8% since the election through 11/25. Large cap stocks are up about 3.4%. Clearly there's been a headwind to international development, emerging market entities. One of the big drivers of that headwind is the currency movements. The dollar is strengthened versus all currencies with the exception of the UK pound, but some significantly more than others. For example, if you look at the Mexican peso down about 11.4% and the Brazil real down about 7.4%, that's a huge headwind for investors in those markets. It was also interesting that a lot of managers were talking about the Trump trade kind of jokingly before the election, saying buy gold. And what's interesting is if you look at what has happened post-election, of the list of commodities we're showing here, gold is down the most of everything. You see the commodities such as copper have rallied pretty dramatically, up a little over 12%, basically on the heels of expecting increased infrastructure spending. So one thing that we can take away from the election is that NEPC really does expect there to be winners and losers significantly on a global scale, and we really encourage you to make sure your portfolio is positioned appropriately going into 2017. With that, I'd like to turn the floor over to Dave Moore to introduce the 2016 Trend Survey.
Okay, thank you, Brad. So we started on slide 16. This will give you a little bit of a sense of the scope of the survey. And this, again, as was mentioned, this is our 6th year of doing the survey. Participants, we had 184 defined benefit plans participate. And that is a very robust number, and interestingly, that is up almost 80% from last year, where we had 102 participants. And that's something that clearly is things that are on, this is a key topic on people's minds, so we're very pleased with how robust this is going to be when we go through this. The median plan in the survey, roughly $750 million in assets, and the average plan, roughly $1.6 billion in assets. If you look at the upper right-hand side of the slide, what you can see there is that there are 39% of plans that had excess of $1 billion in assets, and 61 that were less than $1 billion. In the lower left-hand or lower right-hand side there, interestingly, the focus of the organization, you can see 70% were corporations, 25% were healthcare, and 7% were others. So what we're seeing there is the mix. Healthcare is increasingly starting to focus in on this area. It's been an area for several years, but in addition, the corporates have been focused on this for quite some time. On this slide, what you'll see, plans they do continue to freeze. And what's interesting, and maybe just take a moment and pause here to give you a sense of the color codes of the tables and the graphs we're going to be using. So when you see one that's blue and the gold colors, that is a combination of the blue will represent healthcare, or excuse me, blue will represent corporations, and the gold will represent healthcare. And that's when we're comparing year over year, you'll see a yellow and a green comparison. So just to kind of give you a sense of the color palette. But if we look at this slide, what you'll see is healthcare roughly has 49% when the respondents came back are frozen, corporations 42%. So if we looked at this a couple years ago, those numbers would have been slightly different, but healthcare is clearly caught up and looking to surpass corporates in the frozen category. And then we look in the soft and the closed, soft or the closed freeze, you'll see 34% in the corporations, 33% in the healthcare. And then finally, and interestingly, in the open, when we're going on the left-hand side, 31% of corporations remain open, and from the healthcare, it's roughly 18%. So when we went through the respondents, 71% of those with open plans expect to remain open for the foreseeable future. So what's interesting about that to us is that suggests that those plans that are frozen, soft closed, that's probably, we're not going to see too much of a change in the open. When we dug into that, the most common response was the reason to leave the plan open, it attracts and retains talent, and the funding status volatility risks are being managed. So we don't expect those numbers to move too terribly much into the future. We do see probably some changes in the closed soft freeze and then the hard frozen. On this slide, what you'll see on the down left-hand side, this is the corporate plans, and on the down right-hand side, the healthcare plans. A quick comparison when we dig in year over year. And what you'll see from the corporate plans is 42% frozen compared to 36% last year. And that represents roughly a 17% increase year over year. So again, what we would anticipate and expect as plans continue down the path of exiting this business and freezing the plans. The increase in the open plans, when we look at that, we think that's just simply a survey sample issue, and that's nothing that we don't see a trend taking place there. For healthcare, the trends are very much what we would expect. Nearly half of the healthcare respondents have reported that their plans are frozen, and only 18% of the healthcare plans now remain open. You can see that represents a drop. So as we continue to see these numbers move, the frozen category grows, and while the closed and soft freeze and the opens continue to shrink as a percentage of those that responded. For this page, not surprisingly, when we think about that trend with what we're seeing, this comes to the expected rate of return and the return assumptions that pension plans are reporting. And if you look at this, the box that you'll see highlighted in the blue, last year there was excess of 7%, 64% were above 7% in 2015. When we tabulated this number this year, that number had dropped to 51%. So recognizing that people's rate of returns are coming down as they continue down this path of not only freezing their plans, but also implementing more LDI. So if you look to the left of that blue box, those that are below 7 in the 6 category, last year the respondents, that was roughly 34% of respondents were in that area of in the 6s, let's call it, and now that's 40%. And so we do see that trend continuing, again, as people continue down that path of looking to immunize and looking to adopt LDI with what the prior slide showed as far as their structural changes. In addition, when you take into consideration where the risk-free rate has been and expect then the return pressure on expected rates of returns, that's also another pressure in the low-rate environment that's going to cause continued, we think, downward pressure upon expected rates of return. And with that, what I'll do is that gives you a little sense of kind of the respondents and how they shaped up in the size and the scope. I'll turn it over to Kevin Novak, who'll go delve a little bit more into some more of the details.
Great, thank you, Dave. So I'll begin by discussing the first of 3 key takeaways from this year's survey, and the first of which being that risk management works, or worked, as we'll see on slide 25. Now, earlier Brad mentioned the decline in funding ratios over the past year, which were primarily due to declining interest rates. And we've actually seen that in our survey results this year, with the lower percentage of funded plans, or those we'll call under 80% funded, actually increased from 21% in 2015 to 28% in 2016. Interestingly, and not necessarily surprising, is that 70% of lower funded plans implemented hedge ratios below 40%. And so given the relatively smaller size of LDI in these portfolios, I think it's pretty clear that they did not protect funded status in a significant way. Now that's the bad news. The good news is that well-funded plans, or those for today we'll call above 90% funded, were able to protect their funded status despite the drop in rates. And what we see as somewhat of a proof statement for this is the fact that a majority of well-funded plans actually held meaningful proportions of LDI in their portfolios and implemented hedge ratios above 60%. Now let's dig a little bit deeper on the LDI assets that were utilized to protect funded status over the past year. On slide 27, we've broken out our 2016 results between corporate and healthcare plans. And what we found is that overall 62% of respondents do utilize some form of LDI, but a much larger proportion of corporate plans versus healthcare plans utilize the strategy. And you see the figures on slide 27. Corporate plans come in at about 69%, while 53% of healthcare plans utilize the strategy. So that 69% for corporate plans is actually a 12% increase from 2015. And what's interesting is that 12% increase comes as we observed a 12% decrease in corporate plans indicating that they are now considering LDI. So we think it's fairly reasonable to conclude that these changes are linked to a certain degree, and that plans considering LDI last year actually went ahead and implemented LDI strategies over the past 12 months, which definitely contributed to the overall increase in LDI usage.
And then from the healthcare perspective, what was interesting is when you see that even though there are more healthcare plans that are frozen and even soft closed necessarily than their corporate peers, only 53% had utilized some form of LDI. But part of the reason for that is even though they have caught up and maybe surpassed their corporate peers, a lot had started this process, at least anecdotally, a little bit later. And you can see that in the 21% now considering LDI. So what we would anticipate is in this low rate environment, as rates begin to rise, we should expect to see that trend continue, where the healthcare space, the healthcare providers will start to adopt LDI, but they're a little bit later to adopting it than their corporate peers were.
Great. So for the 38% of plans not pursuing LDI, we noted 2 major reasons as the source of that. And the first of which is that plan sponsors were waiting for interest rates to increase before implementing LDI. And the second one being that plans are still maintaining a total return investment strategy because they are still open. Now what's interesting is what we noted in the different trends between corporate and healthcare plans as it relates to waiting for interest rates to rise. On the corporate side, we saw a reduction in those waiting for interest rates to increase before implementing LDI, whereas on the healthcare side, we saw an increase in the dependence on higher rates. With that said, we still do see a lot of total return strategies across corporate and healthcare plans, and so certainly it is appropriate in those situations to seek fixed income exposure outside of solely long bonds. Now, while 38% still don't utilize LDI today, I think there's really no denying the fact that users of LDI have significantly increased their allocations over the past 5 years. And the chart on 29 illustrates the fact that LDI commitments of greater than 50% of total portfolio assets have actually grown from 9% in 2011 to 36% in 2016. And with that significant increase in LDI assets, we've observed some trends in the type of instruments utilized. So as you see, since 2012, we've seen a surge in the use of Treasury strips, with back in 2012, 10% indicated use of strips, and then that boosted up to 45% in 2016. We've also seen a significant increase in the continued popularity of long government credit mandates, and about 12% of respondents indicate the use of custom LDI strategies. And so those are strategies that are more likely used by very well-funded plans in an attempt to more closely match their LDI portfolios with their liability profile. Now, in terms of what concerns are front of mind for LDI users, the concerns most often cited, and for that I'm specifically looking at the red sections of the bars up on slide 31, but the concern most often cited is the impact to liability valuations due to legislative and actuarial changes. I don't think that's necessarily surprising given the attention that mortality table adjustments have garnered over the past few years. Now, along with the increase in LDI usage over the past 5 years, we have observed a corresponding increase in glide path utilization. And it appears now that over half of plan sponsors acknowledge the use of a glide path. And although we found that 48% don't have a formal glide path in place, we noted a couple of characteristics from this subset of plan sponsors. The first of which being that 36% still utilize some form of LDI, and also that about 40% have a funded status in excess of 90%. Now, for those that formally established a glide path, we did see an increase in those that formally reviewed the glide path over the course of 2016. Interestingly, this came at a time when funding ratios generally declined, and so in that type of environment, what, if any, changes resulted from the review? And slide 34 has the results. And what we see is that about 3/4 of respondents reviewed their glide path, but did not take any changes to their strategy. However, likely because of longevity improvements, declining discount rates, and their impact on funding ratios, we noted that 3% actually re-risked their portfolio, while 23% simply opted to modify future trigger points. And that's coming on the heels of higher levels of re-risking and glide path modifications in 2015, when longevity improvements really impacted plans. And while declining funding ratios didn't translate to changes to the glide path, it did mean that fewer hit their de-risking trigger points, which are often breached with elevated funded status levels. And even those that managed to increase their funded status over the past year and actually hit one of those trigger points, we noted that 67% delayed any action because of their view on the interest rate environment. So that brings us to our second key takeaway, which relates to de-risking. Now, based on our findings, liability reduction strategies, broadly speaking, continue to increase, and we see that illustrated on slide 37. Two approaches to liability reduction strategies where we saw a significant increase in interest were lump sums and annuity buyouts. Now, within these charts, we'll focus on two areas in particular: the dark blue, which indicates the respondent was planning the reduction strategy, and then we'll also focus on the light blue, which indicates actual implementation of that strategy. And what we see on 37 is that there is a 12% increase in the implementation of lump sums in 2016, while the percentage of respondents who implemented or were planning annuity buyouts nearly doubled year over year. However, not all liability reduction strategies experience the same heightened interest as lump sums and annuity buyouts. Plan sponsors either planning or implementing annuity buy-ins were relatively unchanged from 2015. And plan terminations experienced just a slight uptick in interest, but clearly these strategies are not free. They're likely still expensive to execute. And we even noted that over 70% of respondents who didn't consider or rejected annuitization did so because of the cost involved. Now, one interesting piece of information that came from our responses this year related to hibernation strategies, where we saw the actual implementation increase from 2015 at 2% up to 11% in 2016. Although that figure is relatively low in absolute terms, the uptick certainly caught our attention, and perhaps the trend could continue with additional information and education on hibernation strategies. And we say this given the fact that over half of those who considered or rejected hibernation strategies cited not having sufficient information as the primary reason for not pursuing that strategy. Now, one action that may have influenced the general increase in liability reduction strategies is the increase in the PBGC rate premiums. In fact, our findings show that nearly half of plan sponsors indicated they will consider lump sums over the next 6 months. And you can see from the results on slide 40 that, one observation we have is a higher percentage of healthcare versus corporate plans are considering lump sums, while corporate plans are more likely to consider annuitization. I also think it's worth noting here that we did see a considerable increase in potential changes to plan strategy, whether that be from higher contributions, lump sums, or annuities, versus when we conducted a flash survey in late 2015. Now, in terms of alternative de-risking strategies, we did ask a new question in this year's survey that related to debt issuance. And what we found is that about a third of respondents did evaluate issuing debt as a means to increase their funded status. And many of them have already implemented some kind of de-risking strategy, so whether that be lump sums or annuities. And nearly half of those had a funded status of under 80%. So that brings us to our final key point with our 2016 survey, and that is that alternatives remain popular despite the increased usage of LDI that we've observed. And what you see is that 46% still have an alternatives allocation greater than 10%, while the majority expect to maintain their current allocation to alternatives. There appears to be about the same percentage that are expecting to increase as decrease alternatives over the next year. So that concludes our results of the survey. I'll turn it over now to Brad to wrap up.
Thank you, Kevin. We did have a very robust response to the survey this year, and we were able to slice and dice the data a lot of different ways. One of the things we tried to do and analyze was to see if there were any trends in the data, whether the plan was open, closed, frozen, whether it was a healthcare plan or a corporate plan, and to see whether or not that influenced what level of LDI usage was out there. And the answer was it was all over the place. There were really no clear and convincing trends which really support what we see in the marketplace, and that is that risk management is very client specific. And we see our clients, even the clients that the three of us work with day to day, each client really does want to customize their risk tolerance and has a bandwidth, if you will, with respect to how much funded status volatility they're willing to accept. In 2016, it was a very interesting period of time. We saw discount rates come down pretty dramatically. We saw return-seeking assets do fairly strong. But we saw a real bifurcation in the output, if you will, or the outcome for plan sponsors. Plan sponsors that were heavy users of LDI, their funded status held up very well. Plan sponsors that were not in LDI assets, they saw the biggest decline in their funded status. We've also seen a tremendous amount of opportunities or activity in plan sponsors looking to reduce the overall size of the liability. We expect that to continue going forward. And then, the last thing that I think is really interesting is just despite the headwinds in alternatives, a lot of plan sponsors are looking for alternative beta solutions, and they're getting that through alternative assets. So we really do expect plan sponsors in the corporate DB world to continue to use alternatives. We think they're an important tool, and when used properly, can add important diversification. So with that, if you have any questions, please use the Q&A function at this time. We did have one come in earlier, and the question was, let me see, with respect to the issuance of debt, has NEPC worked with any clients that have reviewed and issued debt? If so, any key learnings? Yeah, NEPC has helped a couple of clients evaluate this. We do have one client that I'm aware of that actually issued debt. That client had a very low funded plan. Their funded status was in the low to mid 70% range. The equity analysts were asking a lot of questions about the pension liability, and they started to actually consider it a debt. So the company had some room on their balance sheet to issue more debt. They were actually able to issue debt at a very favorable term, earn a higher return on the, via the EROA on the pension portfolio, and got the plan up to about 95% funded. So it was kind of a win-win, and they did de-risk it. So it was a situation that was kind of like the perfect solution for that client. Do we have any other questions?
Looks like we had one other that came in. This was the healthcare related one. As it looks like healthcare may be waiting to implement LDI relative to corporates, how does the recent jump in interest rates impact that? Are you able to tell at this stage? This is a great question, and I will say that I think certainly the jump we've seen in rates for healthcare, and I think also for corporate clients, has caused everyone to look at their funding status, and I think November will be an interesting assessment when the funding status does come in. What we've worked with, and I think our corporate clients and our healthcare certainly, that really suggests making sure that if you're pursuing a glide path, that you have all the plumbing in place, if you will, so that when we do see interest rate spikes like this, that you're in a position that you're ready to make a move and make a change, even if that means selecting possibly a manager or two, even if it doesn't look like rates are, maybe poised to go up. Because I think what we've seen, particularly back in 2013 with the taper tantrum, and then what we've seen in November, rates can move very quickly, and if they spike up, you want to make absolutely certain that your glide path is well known and that you have a very clear-cut plan of how you will execute and on what basis you will do that. So we've worked with clients, particularly in the healthcare space, to make sure that they're ready to execute that as rates do rise.
Okay, well, it doesn't look like we have any other questions, so that'll conclude this year's trend survey. Thank you for attending. Just putting our normal disclaimers up here to make our attorneys happy, but again, thank you all very much for your time, and if you do have any questions on the survey, or if you would like your plan to be benchmarked, feel free to reach out to one of the presenters on this year's call. You can find the link again at www.nepc.com. Thank you very much.